market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. Happy Thanksgiving to those that celebrate. I'm Francine Lacqua here in London. Global equities close to erasing their November losses, revived by growth optimism, or by growing optimism that the Fed will cut interest rates. Now, sentiment also supported by the possibility of a more dovish new U.S. central bank chief. So we're now joined by Claudia Panseri, Chief Investment Officer in France for UBS Wealth Management. Claudia, thank you for joining us. I mean, look, there's a lot going on. There's always concerns about valuations in the markets, especially when it comes to AI. So we have this like pull and start from the markets. But actually, if you look at the Fed and Fed expectations, the markets are fine because they're expecting a cut.
Yeah, so thank you for having me this morning, Francine. I think the market is very focused on what the Fed is going to do in December, and we are expecting 25 basis point rate cut. The market probability about the rate cut has been decreasing a few weeks ago and now moving back to 80%. So that is quite important. The rate cut in an environment where we see some slowdown in employment market, even if we haven't seen the data for a few weeks now, is supporting multiple expansion. And I have to say that while many clients are concerned about this multiple expansion in US, there is still growth there in terms of earnings. And so the earnings season was pretty good, and we recently upgraded US stocks, but also European stocks. So let's say we meet the market expectation in terms of future performance.
What's your take on equities in 2026? I know we're close to the end of the year, so there's the outlook that's coming up for the year ahead. If you look at AI valuations, are they going to be problematic?
I think one of the particular element is that demand is still there. When we look into the rate of implementation of AI across the different industry remains still very low. So for the time being, what we see are CapEx spending, which has been very strong this year. We have expectation of CapEx rising 2026 and 2027. Demand is also increasing. So valuation in some cases is a bit stretched. But when you look into the companies which will benefit of AI implementation, valuation is around the long-term average. I'm thinking about companies which will implement AI, not only hyperscaler, but really application, and then valuation are around 20 times and not 28 times when we look into semiconductor. When we look into the overall landscape for 2026, with rate being down, multiple expansion can be continue to increase. So we are not concerned about the valuation right now. Volatility will probably increase from time to time. It happens over the last 2 weeks, but we are still convinced that AI will be a big driver for next year. What we are doing, right, we are more, I say, more diversified than in the past, so that's also help.
So how do you diversify your income? And I know, for example, you like commodities, but you also want to take advantage of what's happening in China.
I think in terms of diversification, within the equity space, we have increased Europe, where valuations are quite attractive, but also where we expect 2026 and 2027 growth to pick up after a few years of zero growth. We have been moving positive on Japan with the fiscal support that could push a bit not only the growth on the economy, but also economy on the earnings side. And we have been positive on Chinese stocks, especially Chinese stocks which are linked to AI. So relative to the past, where we have been focused essentially only on US stocks, we are now more expanding our overweight, our preference in our region. And then in terms of diversification, we remain very diversified across asset class. Our call on fixed income is still positive. We are still positioned on high-grade bonds and commodities more recently, with gold diversifying and reducing volatility across portfolio. So clearly 2026 is less concentrated than it was 2025 in terms of allocation, but also we see more growth coming and the Fed continuing to cut into early next year. So really we're still very positive about the global outlook.
Okay, Claudia, don't go anywhere. Of course, Claudia Panseri stays with us because we'll now focus on the UK. Of course, it was budget day. Markets reacting positively, more or less. They're kind of muted, I would say, after the UK Chancellor Rachel Reeves delivered her autumn budget. Now, Reeves also boosted her fiscal buffer with tax rises totaling £26 billion.
I was always clear that I would never play fast and loose with the public finances because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services.
Now, the shadow Chancellor of the Exchequer said it was, quote, utterly outrageous and potentially criminal that the OBR released the budget before the Chancellor gave her speech.
It is unprecedented that this should have happened, that you have a Chancellor of the Exchequer standing up in the House of Commons whilst the entire contents of the budget has been released by the OBR about an hour before she did so. That is clearly completely unacceptable. So we do need a thorough investigation into it to understand exactly what has happened and therefore what consequences should follow.
Well, joining us now is Kit Rees, co-editor of Bloomberg Markets Today. Kit, first of all, I mean, there's two things, right? First, you know, the OBR budget leak, which I'm assuming and hoping it will be dealt with rather firmly, and this we understand is like a digital security lesson maybe for others. But the bigger part, the budget was okay. It didn't ruffle any feathers. But do we worry about growth in the future?
Yeah, well, this is the really big question. I mean, markets seem to be breathing a sigh of relief that after weeks of chaos, speculation and U-turns that, you know, it was pretty much in line with expectations. So there are 88 measures, a huge amount to get through, lots for markets to digest. And while, you know, they are breathing a sigh of relief that it is as expected, a bigger focus on tax, raising tax in order to fund spending cuts, there's this big question over growth. And ultimately, is it going to kickstart the economy, which looks kind of unlikely at the moment. So we'll be hearing, of course, from business leaders and think tanks and the rest of it on what it could mean. But overall, there's still quite a lot of questions left there.
I mean, if you look at the reaction from the markets, I mean, again, it's muted and then you have a little bit of flare-ups as they're trying to digest. I had understood that this budget was never going to be growth positive. So is it in locksteps? You kind of, you know, try and deal with it now, keep the show on the road, and then you take bolder measures further down the road?
Yeah, that seems to be very much the case. So kind of like spend now and tax later. And these things are being pushed out into further years. So there's a lot of uncertainty around that. And of course, with so many measures, lots of this sort of smorgasbord approach, which has been touted, where we have lots of little tweaks, it's not really certain how this will filter down into the economy and affect things later on. Also, it is the Thanksgiving holiday, so liquidity is going to be a bit lower. So any moves that happen, they might be exacerbated, and it might take a few days for this to properly filter through the market. So there's still a lot going on, still a lot to digest, questions over growth and the measures and getting through it all. So we'll see how it plays out in the next couple of days for sure.
Yeah, you're absolutely right. Volumes are muted, so you could see some flare-ups out of nowhere. Kit, as always, thank you so much. Kit Rees there, our co-editor of Bloomberg Markets Today. Now, to discuss the impact of the budget, let's get back to Claudia Panseri from UBS. Claudia, I mean, your take, again, the market, I guess, is now doing a bit of yoga. They're saying, okay, let's see what happens next. And she kind of calibrated, the Chancellor calibrated so that there were no huge surprises.
So I think there are two elements which are quite positive. And I mean, we would love this kind of budget in France and this fiscal room. The first one is the deficit trajectory. So the deficit trajectory is going down. So that is very positive. And the second one is bond issuance. When you think about the market would have been expect much more bond issuance for next year, the reaction will have been negative. And these two elements are taken positively from the fixed income investor. The third element probably is about the Bank of England. I've heard many comments saying that the economy will slow down, but at the same time you have a BOE which will cut rate in December, and then still, according to our scenario, 2 times next year. So I think the risk of growth is offset by monetary policy. So on one side you have some fiscal, let's say, discipline, and on the other side you have a monetary policy able to offset the risk on growth. So this is the reason why the market has been reacting well yesterday.
Yeah, and Claudia, I mean, to your very good point, the OBR was also saying that, these plans will basically knock off some 0.5% percentage points off inflation the second quarter of next year. So was this sought out to give a helping hand to the BOE?
Yeah, exactly. That is also the point. The implementation of the different tools which have been used to push down inflation, that will be positive and will push the BOE cutting rates, which is not always expected by the market. So you may have the short-term end of the yield curve moving down a bit, and that will help as well, to balance the risk I was mentioning before about growth. And everyone is mentioning that there will be impact on growth because of the rise on tax. I mean, once again, I think the UK situation is much better than the French one.
Yes, it's always relative. Claudia, thank you so much for joining us. Claudia Panseri, Chief Investment Officer, France for UBS Wealth Management. We'll talk extensively about France as well. Coming up, we speak to the President of the European Bank for Reconstruction and Development on Ukraine's IMF deal. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, at least 44 people have been killed and hundreds are still missing in what is Hong Kong's worst residential fire in more than a century. 3 people have been arrested in connection with the fire at a high-rise complex. Our China correspondent Min Lo has the latest from the scene.
I'm right here at the scene of the fire in Tai Po, the most devastating fire that Hong Kong has experienced since 1962. It started yesterday at 3 p.m. We're well into the second day now, and yet firefighters are still trying to put out the fire. Rescue efforts are ongoing, and then the crux of the issue is what exactly causes fire, and authorities are still finding that out, but they did say that the spread of the fire was much faster and quicker than usual. This is a very old estate, over 40 years old, and it was undergoing heavy renovations. There were bamboo scaffoldings, green mesh surrounding the buildings, and authorities said some of the buildings were not up to compliance standards. They found flammable materials like styrofoam boards sealing some of the windows, and they have arrested 3 people from the engineering firm for manslaughter and gross negligence. And residents certainly are demanding answers from the government as to why this was allowed to happen. Many of the residents are just completely shocked and heartbroken. They're figuring out what is the longer-term housing situation, and the authorities are now converting some schools in the vicinity into temporary shelters for them. But it's going to be a long, harrowing night for many of these displaced residents. Min Lo, Bloomberg News, Hong Kong.
Well, that's our China correspondent Min Lo. Now, 2 U.S. National Guard troops have been critically wounded in a shooting just blocks from the White House. Officials say a gunman was taken into custody after another guardsman returned fire and moved in to stop him. President Trump was in Florida at the time, but has ordered an additional 500 troops deployed to the nation's capital.
This heinous assault was an act of evil, an act of hatred, and an act of terror. It was a crime against our entire nation. It was a crime against humanity.
Now, Puma is the biggest gainer on the stock 600 today, following news that the Chinese sportswear company Anta Sports is believed to be amongst the firms exploring a potential takeover. Sources say that Anta, which is listed in Hong Kong and owns brands including Fila, has been working with an advisor to evaluate a bid for Puma, whose shares have fallen more than 60% this year. Now, let's bring in our Manuel Baigori, our team leader for Asia Deals in Hong Kong. Manuel, Puma shares have really struggled this year. So what's the appeal for a Chinese bidder?
Francine, the appeal is mostly to continue to expand and to get hold of a very iconic global brand such as Puma. As you well said, the company has been struggling. That's been reflected in the share price this last year. The company also had a new CEO in place. They held a capital markets day a couple of weeks ago with the expectation that a new strategy and a focus on new marketing and new products would rev up and kind of like create a little bit of a catalyst for the stock, but that doesn't seem to play out that well so far. Now the question is, at what price this company can trade? Shareholders, including the Pinot family, who have a significant stake in the company. Obviously, they have very high price expectations. Just a year ago, the stock was trading at 45 euros a share versus 15 euros a share, excluding the bump today, following the exclusive from Bloomberg News. So there is a bit of a gap there that needs to be bridged between potential buyers and sellers. Meanwhile, bidders including Anta and Ning, two very well-known sportswear companies in China, as well as Asics, are doing some preliminary work, talking to prospective advisors, also potential partners, including private equity firms and financing banks, to see if they can put together a bid. So it's slowly moving. There is work behind the scenes being done, but there is a very wide bid-ask gap there that will have, to be addressed and may become a challenge.
Yeah. Manuel, thank you so much, as always, for that briefing. Manuel Bagori there, our team leader for Asia deals in Hong Kong. Now, the IMF has announced an agreement with Ukraine on a new financing program, sending a positive signal to the war-torn nation's international allies. This comes as the repercussions of the war are being felt economically in both Ukraine and Russia. Now, we're joined by Odile Renaud-Basso, president of the European Bank for Reconstruction and Development. Thank you, as always, for joining us. I mean, it's been a complicated situation, frankly, for Ukraine over the last 2 weeks, with the comings and goings with the U.S., the allegations of corruption, very close also to President Zelensky. And then we have the news that actually at the staff level, there could be this big loan from the IMF. How much of this is a game changer?
I think this is a very positive news. I was in Ukraine last week when the IMF was discussing with the authorities, and I think that having this agreement at the staff level on a macroeconomic program for Ukraine is very positive, because it creates an anchor for the policies to be implemented and for supporting countries to continue to support Ukraine in its difficult situation.
Odile, this is basically a 48-month arrangement, right? Under the extended fund facility, so they could potentially, access $8 billion, but there are conditions attached, including adequate financing assurances from donors. What does that mean for what Ukraine actually has to do in terms of concrete steps?
So there are two elements. The first one is indeed they need financial contribution to support the program, as it was in the previous program, and that's where the EU funding is very important, because the European Union is one of the key funding partners for Ukraine program, macroeconomic program, together with other G7 countries such as Canada, Japan, and so forth. So setting the support is very important. And the second one is a policy that Ukrainians need to continue to implement in terms of reform, anti-corruption, functioning bodies, progress in the governance of the state on enterprise, but also fiscal efforts in order to improve tax collection, enhance the tax base, and so forth, so as to have also the capacity to provide more internal resources to finance the big deficit and the war effort.
How delicate is the situation on the ground, given all of these corruption allegations?
So the situation is delicate, first of all, because of the war, and a lot of attacks on civilian infrastructure, on energy infrastructure. So a lot. The situation is, for example, on access to electricity, access to energy, very challenging. This is our top priority at the bank, to ensure that Ukraine has the capacity to support the winter through, for example, providing heating to people. And we work a lot with the authorities on an additional support for the gas company in order to be able to buy more gas and to have supply through the winter, but also build up more generation capacity. So the energy situation is very, very fragile and very worrying. And of course, for people living in Ukraine, it's a very difficult situation because you have a lot of alerts, a lot of civilian victims, and of course the situation of the front is also difficult. But overall, the resilience, the determination of the country is important. You mentioned the issue of corruption. Indeed, there is this investigation going on. On the positive side, having effective anti-corruption body that can investigate freely, put on the public and pursue the people who have been at the core of it is very important. And this is a very positive step. The role of civil society in Ukraine to support also this anti-corruption bodies and so forth is key, as we've seen in the summer. And this is a good progress. And this will need to be followed up, of course.
Have you? I was going to ask because this corruption scandal, has rattled a lot of Western investors, has rattled a lot of Western allies. Have you thought about it differently in terms of putting actually things in place to make sure that it's ring-fenced?
So we've worked already, for a long time on governance, for example, because this case is related to one state-owned enterprise, Energoatom, who is in the nuclear sector, and so state-owned company governance was for us a key priority, has been a key priority, and in the last few years we made some progress. This shows that there is further progress to be done in terms of how the companies are managed, what is the role of the board, what is the role of the government, transparency of procurement, and this is an area where we have worked with a number of companies. On top of our own rules, where we invest in these companies, we have very strict procurement system that we control. Yeah. So, but on top of that, in the management of the companies, I think further rules are important, and this is an area we will continue to focus upon.
Can you give me an idea of timeline? So again, the IMF's decision, as you laid out, is good because it comes amid some battlefield setbacks, because it comes also under this U.S. pressure to accept, these peace talks with Russia. So does the war need to end before access to these facilities, or can you start rebuilding at the same time as fighting?
Now, the program is built on the premises of a continued war, I think, and they said very clearly that this will be adjusted if the war is over. So I think that's the underlying assumption. What will be very important for the program to be approved by the governance body of the IMF, which is the board, is that Ukraine needs to have the financial instruments, and that's where the decision-making in the EU about access, for example, to this reparation loan, building upon the existing foreign asset, will be very important. So the timeline for this decision on funding is absolutely key.
And for the EBRD, how much are you going to get involved in this?
So we are not directly involved because we have our own capacity to fund Ukraine thanks to our own capital and donor support for our financing. So we do not cover the budget gap of Ukraine. We are supporting the real economy, state-owned enterprise, access to energy, but also mostly private sector. And this is, of course, having an IMF program is a good framework, but our funding is not directly related to the IMF program.
Odile, thank you so much for joining us. Odile Renaud-Basso, they're president of the European Bank for Reconstruction and Development, with a very, very important conversation on Ukraine and, of course, the rebuilding and the war there. Coming up, JPMorgan announces plans to build a huge new tower in London's Canary Wharf. Details next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Global stocks gain as traders raise bets that the Fed will cut rates next month. Traders also locking in a December cut by the Bank of England as the pain of tax rises in the budget is postponed. Shares in Puma soar on reports that China's Anta Sports is considering a takeover for the German company. Plus, JPMorgan announces plans to build a new tower in Canary Wharf in what will be the UK's largest office building. Now, the former Goldman Sachs chief economist, Jim O'Neill, is amongst those who've criticised the UK budget for doing little to spur economic growth. The Chancellor, Rachel Reeves, unveiled £26 billion worth of tax rises. Well, she told Lizzie Burden that the move will raise revenue to support economic growth.
Last year, I had to close the black hole in the public finances left by the Conservatives. And in the budget last year, I lived within the forecast set by the OBR. They have now changed their forecasts around productivity, and they are very clear that's nothing to do with the policy of this government. But that does mean they forecast lower tax revenue coming in. And I was always clear that I would never play fast and loose with the public finances, because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services. And that is what this government's plan for growth is all about, whether it's pensions reform, planning reform, the changes today to help make Britain the best place to start up, to scale up and to stay, with the changes to stamp duty for shares for companies newly listing in the UK. I'm determined that we get the growth that our economy has been sorely lacking for too long, and we do that through the reforms that we've set out.
Well, no confirmation of no new tax rises,
well,
Chancellor.
No Chancellor can write future budgets. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
UK Chancellor Rachel Reeves there. Now we're joined by Bruna, Chief UK Economist at Morgan Stanley, and Maren Somerset-Webb, Editor-at-Large at Bloomberg UK Wealth. Maren also just did a fabulous event upstairs on our 8th floor with many questions from many audience members. So thank you both for joining us to try and understand exactly what was in the budget. What's the question you got the most, Maren? Because it feels like the Chancellor landed the plane. Yep. But actually we don't know how she's going to put growth to the test.
Yeah, interesting. This is the big question. Is there anything in there that would drive growth? The answer, of course, being no. And so one of the questions that we kept getting from the audience, and I think if we'd been able to go on another half an hour, we would have heard it again and again and again. The question kept me effectively is, what's in it for me? What are my incentives? And we had a couple of questions from younger people, the Henrys, high earners, not rich yet, saying, why would I stay? What do I get out of this? My marginal tax rate with my student loan is 51%. Those thresholds have been frozen. My income tax thresholds are frozen. I just pay more and more and more and more and more. And we're at this point where the income tax revenues are more or less equal to welfare spend. And this is it's a bad feel for ambitious young people.
Yeah, it's a bad feel, but at the same time, Bruna, it could have been much worse, right? Some of the things that were kind of thrown out there in the last month or not really spooked the markets. And for the moment, the markets are doing yoga and taking a big breath.
Yeah, I think gilts had a good day yesterday, certainly the longer end of the curve, precisely, I think, because the feeling was, OK, a bit better than expected. And the DMO did a lot of heavy lifting there in terms of the issuance profile and obviously the gilt remit numbers for this year in particular, which are things that the market focuses on, just the very near term. Let's take it one step at a time. I think in terms of what was really surprising to me is the degree to which we entered this budget speculation period. I think the real kickoff was NISA coming out saying this fiscal gap could be as high as £50 billion. And in the end, the OBR erosion was £6 billion. It was not much at all, right? We didn't even have to have any tax hikes if we had not had the increase in headroom and spending, and we still would have made it to the balanced current budget in the medium term. I was quite surprised by that, I have to say.
Yeah, it was interesting. We also spoke to someone from UBS about 15 minutes ago, and she's like, well, it's much better than France. France is terrible at the moment because they don't really have a budget and they certainly don't have enough fiscal space. Is there anything good that came out of it?
I mean, interesting, better than expected and not as bad as France. They're not great. I mean, there were a couple of signals. One of the things that we've been lobbying for ages on the podcast is constantly talking about stamp duty in the UK and how we have, basically one of the highest stamp duties globally, and it's really got to go. And my big hope was that she would step up to the plate and abolish stamp duty in the equity markets. That would have been a great step. Now, she didn't do that, but she sent a sort of, limp little signal that, if you IPO in the UK, then there won't be stamp duty for 3 years. It's something. It's the beginning of a recognition that she is occasionally listening, if not taking the best actions, listening a little bit. So, there's a little positive.
I mean, to your point, it kind of felt like it was a chaotic month, frankly, for the last, 4 to 5 weeks. Yeah. It kind of felt like she didn't, it wasn't bold, right?
No.
It was kind of middle down the road, and let's push it back everything to next year.
Exactly. As we say, there was nothing in there for growth. There was nothing in there that really recognized our productivity problem. There was nothing in there that incentivized creative entrepreneurs to just keep going. So yes, it felt very much like, and I think a lot of people have said there's a budget to let Rachel Reeves keep her job, as opposed to a budget for the long-term good of the country. And that, of course, is disappointing. She had an opportunity, particularly with all the trailing, to do something bold, and she didn't.
I mean, the governor, Andrew Bailey, is probably a little bit relieved, because if you look at the inflation, again, it's kind of, the markets now really expect a cut in December.
Yes, so I think that's pretty nailed on. I would say, though, that probability of that rate cut did increase with the labour market data. That was really what kind of solidified those expectations in the aftermath of November. Unemployment rate at 5%. This is something that, given the guidance in November, I think market participants thought, OK, the BOE will take this seriously and lean against that. I think one takeaway from yesterday, this particular idea of not much news here, I think in terms of next year, if you look at it, we had, I think, the direct effect of government decisions is an increase in borrowing of about £3.9 billion. On a £3 trillion pound economy, this is really not much. And the takeaway was, well, for the Bank of England, is there really any news here? I would argue that the drop in inflation probably is marginal positive news for the rate cutting cycle. But in terms of that kind of extra fiscal drag that maybe frees up the path for the market to reprice that very front end, that obviously wasn't there yesterday.
I know in terms of expectations, there's not growth yet. Does a cut from the Bank of England in December, and then possibly 1 or 2 more next year help with growth?
Of course it helps.
Meaningfully?
Well, we'll see, won't we? Because we don't know what the other effects will be. And as I say, you move into an era where you have a historically high tax burden, you have a historically high welfare bill, and you have no obvious plan beyond that wasn't so bad, the Bank of England can cut rates a bit now. It's not enough, is it?
No, it's not enough. But, one of the other things that I know you've been looking at on your podcast is, do billionaires exit? And actually, is there if you look at the non-doms, is there a huge pitfall because people have left and the UK seems uninvestable at the moment?
Yes, this is obviously a problem. The non-doms leaving, that's about inheritance tax. And we talked about this on the podcast this morning. It's about nobody wanting, obviously, to have to give 40% of their estate to the UK government because they lived in the UK for 10 years. This is something that would be quite easy to fiddle with, quite easy to reverse, but we haven't done that. So the incentive remains for the very rich to leave the UK. The incentive remains for well-off foreigners who might invest in the UK to not invest in the UK. But the worrying thing for me, as I think I said earlier, is that we're increasing the incentives for our ambitious, relatively well-off young people to go and build their long-term wealth somewhere else.
And Bruna, overall, because this didn't move the needle at all, do you think the market can go back to it in 1 or 2 weeks and actually say, I'm better off elsewhere?
Yeah, I think it really depends on your view on the economy next year, right? So there's a lot of bearishness on UK growth. But if you think about it in terms of what's priced in the front end of the UK curve, it's kind of 2 rate cuts. It's not even as much as we're seeing in the US, where I don't think the general consensus is as bearish around near-term growth prospects. So I am a little bit more bearish on UK growth than the OBR next year. But that's really why my call on the Bank of England is more aggressive than what the market is pricing. And I think we do need to separate the structural growth challenges, which I agree with, right? 1.5% is just not enough for an economy like the UK, with the cyclical growth challenges, which are really very simple. Savings rate in UK is very high. Cut interest rates and it's going to be lower. Consumers will spend. So it's really about clearing that path for the BOE to cut, and we'll see whether the Chancellor has done enough with this inflation.
Bruna, is it just a win because the bond vigilantes have been kept at bay?
I think obviously the main kind of focus yesterday was really what will the bond market do. I do have to say it's been a really volatile period, and we had a very, very big move in the aftermath of the income tax U-turn, right? Or the apparent income tax U-turn, I should say. So I think it's important to look at the market moves in the context of what we had really last week as well. Yeah.
Maren's looking at me like you're really clutching at straws here. She'll let rip on her podcast. Thank you both for joining us. Bruna, Skarica, Chief UK Economist at Morgan Stanley, Maren Somerset Webb, Editor-at-Large at Bloomberg UK Wealth. And do check out Maren's podcast, Maren Talks Money, in which she gives her take on your money and the world of investments every week. This week is particularly good and spicy. Now, JPMorgan planning to build a new 3 million square foot tower in London that would serve as its principal UK headquarters and could contribute nearly £10 billion to the local economy over 6 years. Now, the bank says the new site would accommodate up to 12,000 people and become its most significant presence in the region. Let's bring in Jack Sitters, our team leader for real estate and European investment. Jack, I mean, this is a surprise announcement from JPMorgan. How big of a vote of confidence is it, A, in Canary Wharf and the UK just one day after the budget?
Yeah, I mean, absolutely. It's huge. And I guess if we take a step back here and, if you'd asked me, or indeed if you'd asked Sir George Jacobescu, the architect of Canary Wharf, the former chairman and chief executive of Canary Wharf, who's advising JPMorgan personally on this, if you'd asked him best part of 10 years ago when the UK voted for Brexit, would JPMorgan be building what is undoubtedly going to be London's biggest office building, one of the biggest office buildings in Europe, in Canary Wharf, I suspect he would have probably said maybe not. There's a decent risk that they don't. But, we had a story the day. It's become clear since COVID and since Jamie Dimon, really leading the charge to get people back to their desks. They've been short on space. We knew that. We knew they were looking at options. We'd reported that they'd drafted in Foster & Partners to look at new plans. But, for Canary, it's huge. They could have left. They could have gone back to the city. I think one of the things it shows us is just how few options there are for big organisations who want a huge new office tower. There just really aren't any being built. Developers have had to put up with Brexit. They've had to put up with COVID. They've had to put up with higher interest rates. There aren't those buildings available. And so JPMorgan has really kind of gone down the maximalist option. They've owned this site for a very long time. They're now going to dust it off and they're going to build an absolutely enormous new HQ there, which will be great for Canary Wharf because that's 12,000 workers who are going to be using the restaurants, the bars, the shopping centres there. Yeah, so,
Jack, what does it also say about Jamie Dimon's legacy? He's put his stamp on Manhattan, and it does feel like he's now doing the same in London.
Yeah, absolutely, yeah. Well, we've got Diamond Town in Midtown Manhattan now, the big new office headquarters, and, a couple of other buildings around it. And we often, when speculating about his legacy, we talk about, 5 years. Well, this building is going to take 6 years to deliver. Yeah, you'd be a brave person to bet that he's not there to cut the ribbon when it's time to open it, and having fully put his imprint on London as well as on New York.
Thank you, Jack. Jack Sitters there, who leads Bloomberg's coverage of real estate and European investing. Coming up, U.S. tariffs reshape global trade. We talk to the company tasked with making sure that inventories stay stocked and that your parcels still arrive on time. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the Pentagon is accusing major Chinese tech companies of aiding the country's military. The U.S. Department is recommending that Alibaba, Baidu, BYD, and others should be added to an official list. Now, for more, we're joined by Matt Bloxham from Bloomberg Intelligence. Matt, as always, thank you so much for joining us. What would it mean for these major U.S. tech firms to be included on the Pentagon list, and how have they actually been responding?
Yeah, I mean, to be honest, I don't think for any of these companies it would make a massive difference to kind of their business because they're not really kind of that big in the US. And I think you have to kind of look at this more in the kind of broader context of the geopolitical tensions between the US and China. I think clearly, the US continues to try to find ways to put a brake on China's commercial military technology developments, and also these companies do supply and do kind of leverage things that are going on in the US market. Obviously Alibaba and Baidu in particular kind of very much in the AI race, so anything that the US can do to dissuade US companies from working with them or supplying key technology to them, I think is going to help the US administration's goal to kind of keep a brake on China's development.
Matt, I mean, we've also had this flurry of, Alibaba stories in the past days, a Qwen chat box, and now they're making a rare foray into consumer hardware. Yeah. How should we read this?
Yeah, with the glasses, look very much like the kind of Meta AI glasses. I think this is an inevitable evolution. They've been very popular in the US and European markets. So it's not surprising that there's a good market opportunity for these in China too. And the technology is there and readily available and can be delivered at a good price point. So for comparison, the Meta glasses cost about $800. These ones, the Alibaba ones, probably about $540, $550. So coming in at a cheaper price and probably as good, if maybe in some ways maybe a little bit better, given what we see in, for example, the smartphone market.
Okay. I've tried actually the Apple Vision ones that were like mind blowing. Yeah, take a little bit of getting
used to. These are quite
to.
Different because they're continuing to allow you to kind of act as normal and just see something overlaid.
There you go, secret spy stuff. Big tech players from both the US and China are warning of potential memory chip supply shortages. How big of a problem is that?
Potentially quite significant. Obviously, we saw, I'm going to say, was it yesterday? I think it was yesterday, Hewlett-Packard, maybe the night before, announced between 4,000 and 6,000 job cuts. That's maybe about 10% of their workforce. And they specifically called out pressure on their costs from memory chips. There's huge demand for memory chips from lots of, pretty much everything we use these days has memory chips in it. But the AI momentum has kind of really tapping demand, and manufacturers are shifting their capability to support that AI race. So we're going to see that. Typically memory is about 15 to 20% of a PC, and some of these companies like Dell are talking about 50% increases in cost. So you could see quite a significant increase in the cost that they're inevitably going to have to pass on to the end customer. So we could well see prices rise for key technology, whether it's consumer or enterprise servers and PCs. So I think it is quite a significant issue. And, we see the memory market go through these kind of supply and demand kind of tensions from time to time, and I think this is just another one of those coming through.
Matt, thank you so much, as ever. Matt Bloxham there from Bloomberg Intelligence. Now, we're almost a year into Donald Trump's presidency, and tariffs will dominate his economic agenda. With tariff rates changing constantly and trade routes being redrawn, how do companies ensure they have stable logistics and supply chains? Well, joining us now to discuss all of this is Oscar de Bock, Chief Executive of DHL Global Forwarding Freight, which arranges the transportation of cargo on behalf of global business customers. Oscar de Bock, thank you so much for joining us. I mean, you do the real stuff. We talk about this every day, but you have to take them from point A, point B with all the geopolitics and, the rewiring of global trade. So first of all, where do you see flows declining, and where are they actually increasing?
Yeah, no, and we not only have to do them from A to B, but we also have to customs clear them as well, which is obviously where the complexity really lies. But indeed, the flows. To start with, what is interesting to see is that the overall global trade is still growing. But the flows themselves are drastically changing over time. And also because of the changes of supply chains that companies are setting up, because obviously everybody has to respond in some shape or form. And that actually happened already from 19 onwards. And the overall, from just in time, we're now actually to making sure that you actually have products available in the right market for the right rates. But so the other impact, which is an interesting one, is that the average kilometer traveled per product is fast increasing overall as well. So you see.
Is this because of trade routes? Because they're changing?
I'll give you some simple examples. For instance, where maybe in the beginning, this is a technology example where you would have produced from China for the US. Now that actually would then be for China to Europe, and then from Vietnam to the US. Or an automotive example, which I thought was even more interesting, is what was originally some from China, US, and then actually became a factory in the Middle East that now does the US, and then actually from China to the Middle East. So you see that there's a colleague of mine always calls it that it's like trade is like water. It finds its way.
I heard the IMF managing director also said that, and I think people kind of forget it's just more expensive. How much more expensive is it to ship from just your general cargo box? Has it increased significantly?
Well, if you come back to the point I made earlier about the average kilometer driven per product, and
it's
so
more
yes,
expensive,
right? So that means that you spend indeed you spend more over time on logistics. Also, the higher complexity that we are creating. I mean, customs clearance, to take one example, the amount of workload on customs clearance has increased drastically. That translates into cost as well. But what is an important element there is the whole digitalization agenda there, because in order to beat the cost part, it's also important to use digital tools. Yes, we all throw in AI and all that, but for instance, on customs clearance, if you're interested, I have a very specific example where you can now see that through using agentic AI, we can increase the productivity on customs clearance by about 20%.
That's impressive.
And that can translate into capacity.
Oscar, you're also a great barometer, basically, of the current state of the global economy. So what are you seeing? Our consumer spending, our businesses weathering the tariff, but also tech transformations?
Yeah, the interesting part is that, one is in the old world, we used to have seasonalities, right? You would have, of course, end of the year, you would have the peak, you have the Easter peak. You don't see that anymore now, because the peaks,
it's all the time.
Well, no, the thing is that you have lots of peaks, because every time that there's some kind of announcement of some kind of new regulation, then there's an acceleration of shipment. But then the stock is already there, and then it's so this year you've seen complete different trends in ups and downs on capacity than what you would normally see, and therefore you don't see the same high season, peak season that you would otherwise see.
That's so interesting. So do you think this is to stay? And if you look at the first quarter of 2026, how are you doing in terms of demand and pricing?
Yeah, the way we look at 26 is sort of a careful optimism, as in it will probably be more stable. But I'm very careful saying that, because ever since I'm part of the board of DHL Group since 2019, every 6 months there was something unexpected that we could not foresee, and I think that is probably something there to stay. But putting that aside, the way we look at next year is that it is sort of slightly better than this year, flattish.
So give me a sense of what sectors you think will see the most weakness and the most strength.
Yeah, so you see, when you look at it sector specific, you have sectors in transition. So for instance, you have the healthcare sector, which is very much in transition from traditional prescriptive medication towards patient-specific medication, which has a whole different logistic flow. That sector, whatever happens with trade, is a sector that is evolving and growing. You see data centers, which is mind-blowing, the amount of investments that are being done in data centers, the point that was made earlier on semicons. Also there you see a major growth in semiconductors, because as was stated, semiconductors sit in everything at the moment. So data centers, because there's an enormous speed of investment and a high complexity of logistics to build that. We basically fly all that, and it has to be fast, and it has to be a high quality level. So, so that's another sector. On the other hand, you have the automotive sector, which is a sector definitely in transition. Not only where it's produced, who's winning the game, but also electric vehicles have less parts and have a complete different setting than traditional vehicles. So there you see a big change.
Oscar, we're also expecting shipping lines to restart returning to the Red Sea. What does that mean for global trade?
Returning to?
The Red Sea?
Yeah. So that's the interesting question, right? When is it going to happen?
And what happens?
And what's the implication of it? So the when, I leave that, obviously, because that's more a political question, because that all depends on stability. When it does happen, it has, there's a lot of different scenarios that you can look at on what will actually happen. Because one, of course, there's between 10 and 15 days less travel time. So that means that you have an increase of capacity, but you also suddenly then have an increase of volume that goes into the same European ports. So that will have an implication on supply chain. So I think this effect that you've seen after COVID, for instance, you're also going to see probably here, because you need a whole supply chain that needs to stabilize, because consumer confidence will increase, most likely, so demand will increase at the same time, and then it all depends on what happens when, on how this ripple effect in supply chains will actually happen.
So interesting. Thank you so much, Oscar de Bock. There, we covered a lot of ground, and I could talk to you for a lot longer, because it's always fascinating to understand exactly how this changes. Of course, Oscar de Bock from DHL. Now, there's quite a lot going on in the markets. Stocks overall heading for their longest streak of gains this month. A couple of caveats. Let's wait to see exactly what happens tomorrow and that Monday against Thanksgiving in the U.S. So volumes may a little bit short, so you can have a little bit of quirky reactions. Bitcoin trading above $91,000 for the first time in a week. Gold little change, dollar pausing a 2-day retreat. Up next, Bloomberg Markets, and this is Bloomberg.